House prices both in the UK and the US have been incredibly resilient to the pandemic, but the key question now is whether that's going to continue into 2021. And personally, I think there are many factors which suggest we are going to see a correction in the fairly near future. So in this video, we'll look at the reasons for that. And if you don't want to watch the UK bit, which will be at the beginning, you want to scoot forward to the US bit, then you can always do that by looking at the chapters underneath. But I suggest that you do look at both because it gives you a broader picture, and they have many factors in common. So I'll start off by looking at what those factors are which drive house prices. Now, probably the most important of all is our income. Many of us buy a house with a mortgage, and banks lend to us as a multiple of our income or our disposable income. And if our incomes aren't increasing, then we can't afford ever higher prices. So either banks being less generous in providing credit or slower income growth are both factors which weigh on the housing market. And both are in fact the case in the data that we can see right now. And of course, there's also supply and demand. You know, how many new houses are being built versus how much new demand is there for those houses. And of course, the demand comes not just from immigration or people having more children, but also if we have a trend of people living more in smaller groups or even living alone, because that means we simply need more houses. And since many of us rely on mortgages in order to buy a house, then interest rates are another factor which is incredibly important. And that one's actually quite supportive at the moment, almost anywhere you look. And don't forget, if you do want to learn more about investing, you can always sign up to our free weekly market roundup. There'll be a link above me that lets you sign up for that very easily, or in the description below. Now, before we get started, it's a really useful thing to have a bit of context and look at long-term house price growth versus something like a global equity portfolio. So this red bar that you can see here is the return on the equity market, the global equity market, once you subtract the rate of inflation, and that averaged over the last 120 years. And that's more than you'd have got if you had invested in property in any of these countries. So property prices are intermediate between bond price gains, so that's government bonds, and equity market gains, with the greatest returns by far being from the equity market. And these are real returns, so this is above the rate of inflation. So if you are looking to invest for capital gain, then the equity market is the place to be, not the property market. That's certainly been the case historically in a very consistent way. So let's start off by looking at a really supportive factor, which is interest rates. Now we're currently here, and the data goes all the way back to 1960. And you can see that we're at record low levels of interest rates. And that's because central banks are keeping interest rates low in order to stimulate the economy. And that's a direct effect of the pandemic. Central bank policy is as accommodative as it is possible to be. And it's likely to stay that way for some time while growth remains weak. And that's not just in the UK, that's in the US, the Eurozone, Japan, almost anywhere you look. And because mortgage interest rates are usually that bank base rate plus some kind of credit spread, that means that mortgage funding is very cheap at the moment, which means that it doesn't cost us as much to fund a certain price of house. And that's certainly a supportive factor for the property market all across the world. And looking at the UK market in particular, you can see the effect of having those low interest rates. If we look at the average variable rate mortgage in the UK at the moment, this is based on data from the Bank of England, you can see that the rate is very low, probably as low as it's ever been, with the average of about 3.5%. Of course, you can have fixed mortgages, which then go to floating, but usually those will all be layered on top of the bank rate, which is extremely low. So that's certainly a strong supporting factor, which would tend to increase house prices. And if we look at house prices in the UK, one really important factor in the UK, which has brought forward house purchases, is the reduction of stamp duty. So people have been bringing forward their house purchases in order to avoid that stamp duty increase again. And that applies to the first 500k of any transaction in England or Northern Ireland. And it's going to expire at the end of March in 2021. The volume of house purchases has soared because many people were trying to avoid that stamp duty tax increase. And as a result, there's a backlog of processing, which means that usually there'll now be a 5-month delay from the time that you agree the sale to completion of the sale, which means that time is now running out to avoid that stamp duty increase. You can see the effect of that stamp duty reduction and the pent-up demand in the prices underneath me. Currently, according to Nationwide in October, we're seeing the most rapid house price increases over the last 5 years. And consequently, house prices in the UK, on average, are at an all-time high. Now let's consider the supply of housing in the UK. Beneath me here you can see some of the factors which drive demand for houses. Life expectancy has kind of slowed down, so that's not a big driver anymore, and it's likely that immigration after Brexit is likely to slow down somewhat. And we'll come on to the next two factors later on, but what we really have seen in the UK is a growing number of one-person households, and that's increased demand for houses, or it's meant that more people just stay in a house and don't make it available to other people, usually younger people, as they stay in that house as they get older. But if we combine all of those factors for the UK, most people estimate that you'd need over 300,000 new houses to be built every year. And the net supply has certainly been below that for some period of time. And looking at the latest data, there's very little evidence that we're going to hit that 300k house building target. This is the latest data I could find, which ends in 2019. And if we look back to 1923 to see whether it's private enterprise, housing associations or local authorities creating that new supply, the huge post-war house building spree was mostly from local authorities. And private enterprise has been doing a fairly constant job of generating new houses, but it's gone nowhere near to producing that level of new supply. So this lack of supply in the UK is likely to certainly keep a floor under UK house prices. And just like low interest rates, that's going to be a supportive factor which will stop an all-out crash. But if the government does manage to hugely increase house building like it did after the Second World War, obviously that would be a huge downward pressure on UK house prices. Now let's think about affordability. Many of us buy a house using a mortgage, and so it's really important that credit should be available to us in order to make that happen. Now, during a recession, usually banks make credit harder to come by. So the number of mortgage approvals is really important in order to keep the housing market ticking over. The red line here is the number of mortgage approvals, and you can see it fell massively during the lockdown period, but then recently it's surged as many people have brought forward their house purchases. So for a significant number of people, the credit availability is certainly not a limiting factor. However, what we do see is that the house price to earnings ratio is at very high levels. And if we look back even further, I've only gone back to 1990 here, this is a very extreme period in terms of house price to earnings ratio. So currently in the UK, the average is that it costs about 6 times your salary to buy a house. So the answer to the question, are we currently in a housing market bubble, is almost certainly yes. We're paying a huge amount in terms of our annual salary to buy houses. And if that's the case, then normally in the decade following, we don't get great house price returns. So this is certainly a negative factor for house prices in the years ahead. Now, there's a huge divergence in the UK in terms of affordability, and here I'm looking at the price to earnings ratio for just first-time buyers. You can see that for London, it's incredibly expensive and affordability is very poor. Whereas if we look in the north, the story is completely different. It's much more affordable to buy in the north. And the Office for National Statistics has an incredible interactive tool so that you can find the affordability even down to the most tiny regions in the UK. But the general pattern that you can see is that London is extremely expensive, and there's a swath of the south which is also very expensive. Whereas in this green zone in the middle of the country and in the far north, house prices are much more affordable relative to our incomes. So here's that interactive tool, which actually lets you scoot backwards in time to see that regional breakdown. And if we go back to 2003, you can see that that north-south divide certainly wasn't as marked as it is now. And this is for 2003. And as I increase time, so this 2005, 2006, you can start to see the South becoming much more expensive. There was a bit of a hiatus in 2008 when we saw the consequences of the global financial crisis, but since then, there's been a steady increase in that north-south divide, culminating in where we are now in 2019. And if we drill down even further, you can also break it down by particular councils. So this is Kensington and Chelsea, which has the highest multiple of average earnings in terms of house prices, which we can contrast with Tower Hamlets, which is much more affordable, but London has the biggest dispersion in terms of affordability. And as we move away from London, you can see that the dispersion grows smaller until we see the northeast, where there's very little dispersion in house price affordability. So it's certainly worthwhile looking at particular pockets of the country rather than just aggregating everything into one average. But generally, it's certainly the case that for many people in the UK, affordability is not a supportive factor right now. Now let's consider income growth in the UK. The blue line here is average income in the UK, excluding bonuses, expressed as average weekly earnings, and this is adjusted for inflation, so it's real earnings that you can see here. And the green line is if we also incorporate bonuses. If we exclude bonuses, we're about where we were 12 years ago in terms of our income. And if we do include bonuses, we're actually below where we were 12 years ago. Some people refer to this as the productivity puzzle, but really what it means for you and I is that our standard of living hasn't increased for over a decade. But what it means in terms of the housing market is that unless we do see a pickup in wage growth, that's going to provide a drag for the UK housing market, because our mortgages are usually a multiple of our income. Now you'll probably see that there is a spike here towards the end of the time series after lockdown. The reason for that is that we've seen a lot of layoffs in the customer-facing service sector type of jobs, which tend to be low paying. And as a result, that's pushed up the average income for the rest of the economy. So that's a result of the composition of unemployment rather than a good story about wage increases. And if we do look at those redundancies, they've certainly picked up recently, and it's likely that that increase is going to carry on. And the reason why that's likely to continue is that we're seeing further restrictions as coronavirus spreads again at the end of 2020. Companies are having to reduce their expenditures in order to stay afloat, and one of the biggest expenses is usually staff. So it's very likely that that trend will continue. A very timely way of measuring unemployment is to look at the number of people on company payrolls. And so far in 2020 at least, there's no sign of a pickup in employment. So that's certainly a negative for the housing market. If we put all of that together, what does it tell us about the near future? The black line here is UK GDP growth. So when it goes negative here, you can see we've got a recession. And the red bars show periods when house prices are falling, the blue bars when house prices are rising. Notice how when economic growth is weak, i.e. the black line goes negative, we usually get falls in house prices. So I think we could quite easily see a fall of 20% in the UK housing market. It really depends on how quickly economic activity increases, which in turn is driven by the virus and lockdowns. It's certainly not looking like this is going to be a quick rebound. And here's a quote from Russell Galley, who's managing director at Halifax, who also thinks it's highly unlikely that the housing market will remain immune to the economic impact of the pandemic. And the reasons he gives are that employment support measures are going to be scaled back after October 2020, and we're going to see unemployment increase. Now let's consider the US. The rate at which you can borrow in the US, and this is of course just an average, is extremely low for these 30-year mortgages. Currently it's the lowest it's been since 1970. In fact, it looks like this is a record low of 2.8% on average. And that's for data going all the way back for more than 50 years. So because you can borrow cheaply, that's a big supporting factor for the US housing market, just as it is for the UK. And if we look at US housing starts, which is a read on US supply, where housing starts in the US are defined as starting the excavations for the footings or foundations of a building, the story just before the global financial crisis and the subprime crisis in the US was one of huge oversupply. But then you can see the supply fell massively going into the Great Recession, and it's only been gradually increasing over time. So certainly the supply is nothing like it was in 2005, and it's certainly not looking like there's oversupply in the US. And again, I think this is a supporting factor in the US, assuming the demand for housing is still there. But it's interesting that the US lumber industry timed things very badly, and they also misjudged the amount of demand for new home construction. And as a result, we saw a huge spike in timber prices, which more than doubled up to September 2020. So this shows that even experts in the market can sometimes misjudge the amount of demand. But the key factor to monitor to see whether house prices are growing unsustainably is to look at the rate of house price growth relative to income. So the blue line here is the median US household income. Now that only updates annually, which is why it looks kind of blocky. And the red line here is the Case-Shiller National Home Price Index, which is an average for the entire US. Now you can see the two are growing roughly in line with one another during the 1990s, but then when we saw the house price bubble leading up to the global financial crisis, there was a huge increase in house price growth, which wasn't matched by income growth. But what you can also see here is that there is a slight outpacing of house price growth beyond income growth, although it's not as extreme as it was in the decade leading up to 2006. And if we look at the house price to income ratio, so we divide the red line by the blue line, we find a number which is kind of middling. So compared to the UK at least, in aggregate, the US housing market does not look like it's in much of a bubble. But that's assuming that incomes continue to grow at a fairly good pace, which they've been doing in recent years. It was really noticeable in the data leading up to the pandemic in March 2020, and you often heard the Fed talking about it leading up to March. The key question is whether that income growth will continue. Now, what we've seen is that the interest rates that you have to pay on a 30-year mortgage are very low. But then the next question is, how easy is it to actually get a mortgage in the first place? So to put that into finance speak, how tight are credit conditions? And that's what the Senior Loan Officers Survey tells you for many different types of loan, including residential mortgage loans. And that's the time series you can see here beneath me, going back to 1990. Now the way to read this graph is that if the number's going up, that means that you've got tighter credit conditions, which from your point of view means it's harder to get a mortgage. And if it's harder to get a mortgage, that's going to act as a drag on US house prices. Now when do banks tighten up credit conditions? Well, of course, it's when they're worried about making a loss on housing loans. So we had a very long period of easy credit conditions leading up to the global financial crisis in 2008. But you can see that what happened then was that they tightened up the credit conditions for almost any size of loan. And it's only once credit conditions started to ease again that we saw housing prices start to improve. Now, lending conditions have been fairly easy over this very long period of time since then, but what's very visible in the data is a tightening of credit conditions for every type of mortgage again. It's still not quite as bad as it was in 2009, but what's very clear is that we've seen that very sharp tightening of credit conditions to almost 2009 levels. And if that credit tightening continues, that's going to be a drag on US house prices. And the amount of time we spend in these tight credit conditions will, like everything else in the economy, be driven by the effects of the pandemic, but also the scarring on the economy after the pandemic ends. Because usually credit conditions worsen for a while and it takes time to feed through from the economic effects into the effects on credit. And if you want to monitor the effects on the economy of the pandemic, a very good place to look for timely data is in the unemployment numbers. So here's data from the National Bureau of Economic Research, NBER, broken down by industry. So the orange line here, and I've only shown two of the industries, which are the most extreme ones. The orange line is professional and business services. And there were about 22 million Americans working in that sector just before March. And it's very quickly recovered, but still isn't at the levels we were at before. But compare that with a very customer-facing type of role where you can't work at home or do Zoom calls, which is the yellow line, which is leisure and hospitality. Now that was employing about 17 million Americans before the effects of the pandemic, and that's fallen much further. And it's still only recovered about halfway to where it was before. So not only are we seeing a bigger effect on those fairly low paid jobs, we're also seeing a more long-term effect on employment. Now remember that the people who actually have houses, and particularly the higher end of the housing market, will be the people who are in this orange sector. Lower cost housing will be primarily affected by the yellow line. So we might expect to see some kind of divergence in the house price increases where the higher end of the market is fairly resilient, but the lower end of the market is perhaps affected more. And if we break it down by educational attainment, the unemployment impact's been greatest for those with less than a high school diploma, whereas those with a bachelor's degree and higher, which is in green, or at least I hope that's green because I am colourblind, the effect there has been much smaller and the recovery's been much more rapid. Or as Heather Long puts it, the recession is largely over for the rich. The working class remain in deep pain. So those with greatest wealth in the United States tend to be primarily the stock owners, the homeowners, and those with the most pandemic resistant job market. And that's why equity markets, but I guess housing markets also, should be fixated on these stimulus checks. The expiry of the $600 unemployment insurance is going to have a negative effect on both of those markets. And conversely, if we do get a stimulus once the election's over, that'll be a positive for both markets. And just as with the UK, there's a very different story if we break down the house price growth over the previous year by major city or by state, with Phoenix, LA, Portland and Minneapolis doing particularly well, whereas Chicago, New York, San Francisco and Dallas have had much lower returns. As with any housing market, the story is very much based on location. And one of the long-term consequences of being able to work from home may mean that many of us move away from big cities into more rural areas, which would tend to push up the housing prices in those areas. But that really depends on whether these short-term trends in terms of home working extend further into the future once we go back to some form of normality. As of June, over 4 million American homeowners were on forbearance plans, which meant that they could delay their mortgage payments, but of course they still owe that money, so it's just a matter of delaying the payments. But that was an incredibly important program which ensured that people didn't lose their house if they lost their job. But of course, at some point, those forbearance plans will end, and as a result, we will see foreclosures start to increase. And the way this is measured is to look at 60-day and more severe 90-day delinquencies when people have been unable to repay their mortgage. And currently the 90-day delinquency rate, which is the most severe one, is at the highest level it's been since the Great Recession. But it's reassuring to see that the more recent 30-day level of delinquencies has dropped in Q2 2020, which suggests that we may be past the worst. And certainly while we carry on seeing home price gains, the amount of people who have negative equity will be fairly limited. What was particularly distressing in 2008 and 2009 was that home prices were continually dropping, which meant banks had an incentive to foreclose and to sell as soon as possible. Whereas if home prices are still increasing, there's really no hurry to foreclose on the property. And certainly this time round, there's still the ability to get loan deferral and also to get modification options so that you can reduce your payments for some period of time. So both in the US and the UK, I think things are going to get a lot worse before they get better. The effects of credit tend to be delayed, but also a tightening of credit conditions is going to weigh on both of those housing markets. And we'll also see an effect of unemployment if that lasts a very long time. And it's certainly not looking like this is going to be a very quick recovery. We've seen a very long tail of unemployment following those initial lockdowns. And it's looking like the effect of the pandemic is going to be quite long-lived. So personally, I think that we could see a correction in both those markets. But I'd love to know what you think. So do tell us, put it into the comments below. It's always great to see a debate in the comments, but of course, keep it polite. People tend to get very riled up about things like the housing market. So please do consider supporting us. You can join our community on the far side of the page. Just click on the Patreon icon in order to join us. And you can see all of the goodies that you get as a member. Primarily, you'll get to join Slack and you can ask questions of me and other members of the community about the housing market, investment, or any topic you like. So, as always, thank you for listening.